Transfer pricing. This is another easy and very important chapter. So first concept we have is goal congruence. So when there are two divisions in a particular company, each will have individual objectives definitely, and they will work towards the organization goals also. When these individual objectives align together to complete their organizational goals, that is what is called as goal congruence. Now let's come to interdivisional transaction. So when a company has two divisions, there will obviously be involvement of interdivisional transactions. They can either transfer the goods or services, or they can make payments for intellectual property or brand or loyalty, or they can even give loans at a specified rate. When these transactions happen, they have to be valued. That valuation is called as transfer pricing. Now, how is this transfer pricing important? How is it utilized? First, it is used as a tool to evaluate the performance of each of the divisions. And then it helps in employee engagement and compensation based on their performance. And then it also helps us to allocate the resources based on whether it is profitable or it is not profitable. Then finally we have taxation and profit remittance. Taxation, we will get benefits. We will see more of it in our international TP. And then profit remittance. How do we remit these profits? So these are the uses of transfer pricing. Now that we know that we have to measure these, how do we measure it and what price do we measure it at? So transfer pricing has always to be measured at arm's length price. Now what are the methods? So there are three main methods. First one is market based, where we will see what is the external market price, what is the rate at which we can sell the product externally, minus what is the cost saved due to selling it internally. It can be packaging or it can be advertisement, all these costs that are saved. That will be the transfer price. And the second one is cost based. In here we have four different types. First one is marginal cost based. Marginal cost is the cost incurred for each additional unit produced. So that will directly be the transfer price. And second one is standard cost. Standard cost is not the actual cost, it is predetermined from the budgets, based on which we will fix the transfer price. And third is full cost. So in here, when we are calculating external market price, we are subtracting the cost saved, right? Here we will add that also, whatever the selling and distribution expenses and also the administration expenses to the full cost of production. And finally we have cost plus markup based. This is markup. Here we will take all this full cost plus we will add a markup, which is profit margin that is expected by that supplying division. And finally we have negotiation based. So when a supplying division is selling to the purchasing division, these managers come together and negotiate a price that is between market and which is between the cost. So that is negotiation based. Now let's come to transfer pricing and goal congruence. So even though these are two different divisions, they are working under one single organization. So both of them should be at a profit level, or the price should work for both of them. So now we will see what is the minimum price that can be given by the supplying division and what is the maximum price that can be paid by the purchasing division. Okay. So first, minimum price. Minimum price will be additional outlay cost, which is marginal cost plus any additional cost in cases of storage or transporting to the second division. That will be the additional cost incurred by them. This will be per unit. And plus opportunity cost. This opportunity cost is the benefit foregone. If they have sold it externally, if they would have got 6 rupees as a contribution, now this will have to be added to this additional outlay cost to bring up the minimum outlay cost. Let's understand this by an example. Let's say the supplying division has a marginal cost of 14 rupees and the external selling price for them is 20 rupees. Now if they sold it externally, they will get a contribution of 6 rupees. Now when they are selling internally also, the minimum price that they have to give is 14 rupees, that is marginal cost, plus opportunity cost of 6 rupees, that is 20 rupees. This should be the minimum value that they have to agree. And the maximum value will be fixed by the purchasing division since they are paying it. Now this should be lower of net marginal revenue, that is the revenue that they will get by further processing this product that they have got from this division and then selling it externally. This is external selling price of the processed product minus marginal cost incurred on this. That could be the further processing cost. That will be the net marginal revenue. And second is external buying price. The whatever products that they are getting from the supplying division, they can also get it from the market. What is that price? That will be here. So whichever is lower will be their maximum value that they are ready to pay. These two formulas you have to keep in mind always, and this is just common sense. If you see the question, you can directly answer it. Now this formula will change in two different circumstances. First, when the supplying division has excess capacity. Here, we will not be adding the opportunity cost. So the minimum cost will be the marginal cost only, and the maximum will be the same, net marginal revenue and external buying price, whichever is lesser. And when they are supplying at a full capacity, now here we can add the opportunity cost. This is the same formula, and the maximum will be the same, net marginal revenue and external buy-in price, whichever is lesser. Now, what to do in cases of conflict? Conflict in fixing the transfer price. In cases of conflict between these two divisions, we can either go for dual rate. Here, the supplying division will record at a separate price, which let's say 20 rupees, and the purchasing division will record at a separate price, let's say 14 rupees, whichever is convenient for them. Here, what the problem arises is when they are doing accounting in an organizational level, these will be difficult for the company as a whole in preparing their financials. And the next way to resolve it is two-part transfer pricing. Here, we will add the marginal cost incurred, and they will also add a lump sum charge. This will be a part of fixed cost that they will agree. And finally, the last concept we have is international transfer pricing, which is also very, very important, also very easy to understand. Here, instead of the divisions in the same country, the one division will be in one country and the second division will be in another country. So all the problems, all the benefits that we get in the divisional transfer pricing also applies here. Additionally, we will have a tax benefit. How is it possible? Let's say a country A is a low tax rate and in country B we have higher tax. Now the supplying division should price it at a higher quantity. So if they are located in a low tax rate, so that their sales will be high, their profit will be high, and they will pay low rate tax. And the country B, since it is all priced high, the purchase is high, which means the profit will reduce. Again, we are paying low tax. So on an organization level also, this is beneficial, and in individual divisional level also this is beneficial. That is tax benefit. And the second thing that is extra is currency management. Now, because these divisions are located in different countries, there are exchange rate fluctuation risk, and due to which the cash flows will be very uncertain, and it can even misrepresent the performance of the divisions. So how can we make it beneficial for us? We have to plan in such a way the high tax currency should be facing a currency loss, and the low tax rate currency should be having a currency profit. It will be beneficial for the company. That is all about the chapter 12, transfer pricing. I suggest you to practice all the problems in this chapter just one time. It will be enough for you. You can easily do it from your internal knowledge itself, and it is more of a common sense than the formula studying. Hope this video helped.